underwriting discipline to me means striking a balance between helping your client still being profitable.
Hello everyone, and welcome to Reinsurance Business TV as we gather again for our Q2 edition. The reinsurance market enters the second quarter of 2026 with abundant capital, softening in some areas, a persistent caution in others, and growing debate over how the industry should respond to emerging and systemic risks. So it's a great time to check in with our experts for their thoughts on how the market is developing, and this time it's a one-to-one recording. So let's welcome for the first time Sandro Kriesch, Managing Director, Head of ILS at Arcus within Acrisure Re. Sandro, welcome to Reinsurance Business TV.
Hi, Paul. Thank you. Very happy to be here. Thank you.
Great to have you with us as well. So let's start by setting the scene a little bit if we can, Sandro. Reinsurance capital, as I said, remaining abundant and indeed pricing pressure now building. So how are reinsurers maintaining that underwriting discipline while still deploying capacity in a competitive way?
Yeah, I think it's the question we usually ask every year, right? I think when I recall, and going back probably three decades when I started reinsurance, I was working with Swiss Re, and at that time, we even tried to figure out whether there's some more analytical way to understand the reinsurance cycle. By then, there was more acceptance of it's just happening, as capital comes in and goes. And so the market, that is insurance, reinsurers, brokers, have accepted that this is the fact. And now we're going to a bit more softening cycle again, and it happens differently with different lines of business at different times. But essentially, as you asked, really, it's about the capital being abundantly available or not, or being pulled out if something happens, And if we understand better how to respond to this, we'll all be probably happier about this. But I think underwriting discipline to me means striking a balance between helping your client. You can look at it from an insurance or reinsurance perspective, or broker in between, helping your client to do his, her job, and being economically safe on your side, on the other hand of the stick, and trying to not acting too haphazard, too quickly, but slowly. And back in the days, and I guess even now, the trick about being disciplined about this fact is you would look at prices and you look at conditions. And the normal way is that you would probably accept weaker prices before you accept weaker conditions. Because what tends to be the fact is that conditions are sticky over cycles and prices do change, as we just elaborated. As capital goes in, there will be prices coming down and the other way around. But conditions tend to stick, and you have to have more discipline about changing those conditions. So that will mean over time you go through clauses and you adapt those again. You have to discuss it with your clients, and it's just more effort than just, quote unquote, just going up 5% or down 10%, which is painful economically, yes. But the discussions about conditions tend to be a bit more hard, simply speaking. Yeah. So yeah, a short answer is underwriting discipline means understanding your client, helping him, her, and yet remain an economic discipline about still being profitable. I mean, we all want to be profitable, right? So that's what's happening.
If we just elaborate a little bit on those sort of difficult conditions at times. So casualty, of course, remains one of the most closely watched areas in reinsurance. So how concerned right now are market participants about reserve adequacy and indeed social inflation in the current environment?
Yes, a very important question. And I look at it more from an angle of the property underwriting is where I come from, or even insurance-linked securities side of things. So starting there, we know that casualty did not find its place swift. It took some time. Why? Because from a collateralized perspective, obviously anything that takes time to be released on the reserving side, or just as on the claims behavior side, is not good for your business. Meaning, capital or profits are diluted rather. And so this is a line of business that was not really accepted well. But now as we speak, over the last couple of years, more and more ILS business has come into that arena. And now I'm trying to address your question, really. So this is a bit of a backstep as an introduction. So the trapping of collateral was an issue and still is an issue. So when we're looking at ILS and casualty, it would mean that it is an ILS area or line of business that is a bit less long tail, if that really exists. I mean, even in property, we think that property is short tail per se. That's not a fact. I mean, there's property business that takes 3 to 4 years to develop or longer. And so to some degree, it's a bit of a fallacy of just accepting property as short tail. But casualty, obviously, quite another beast. So in the form or the most dominant form of people think of it, cat bonds, we haven't seen ILS really, we haven't seen casualty, to come in yet. But now more sidecars coming to the field. Just recently in the press again, we've seen a bigger Bermudian player, an insurance company, offering casualty business. But look, I mean, the problem of inflation pressure from whatever angle it comes, social inflation or court costs in dealing with casualty is obviously an ever-present concern of investors in that field. But it seems so that the world around us has changed as well. And so the attractiveness of insurance business as an investment place has increased. And so the reluctance of having to accept casualty or longer tail business has been reduced over time, given what's happening around us. And so we do see investors accepting casualty, despite the fact that social inflation is an issue and a clear concern. But the bigger concern still in my field is the trapping of collateral, the long-term effect. So the collateral per se being affected in that business.
Of course, another wider concern, if you want, for the industry at large is the buildup of climate-related losses. They are, of course, mounting globally right now. So do you think, from your perspective, Sandro, is the industry doing enough to address this long-term insurability challenge?
Yes and no. Again, maybe I have a short step backwards, maybe 20, 30 years back, or what are reinsurers doing in that field? And I think they're doing quite a lot. Again, as an ex-Swiss Re employee, I recall quite lively back in the 90s when a big building was built on the shore of Lake of Zurich called the Center of Global Dialogue, which is still operational, which holds a lot of sessions inviting, not only industry representatives, but also people from governments, supranationals, industry representatives in various shapes and forms, and trying to understand what's happening around us, supporting what can be necessary in the future. And here is the no side of things. So yes, I think there's much done in understanding what's happening and understanding which products can help. So we're working on a lot of products, kind of working on the symptoms, but not on the cause, really. And that's the no part of your question. I think must be done more. But how do we really know what's happening in the future? So here we have to look within one eye in direction of the industries like the IPCC or bigger industrial players who understand what climate change really means to the industry. I think it is our task to really come up with solutions and find ways out of the problem. We cannot change climate change per se. We can all have our individual influence on it, and we can try. But as an industry, I think it's important that we find solutions such that people living in areas where hurricanes happen, where tornadoes happen, where wildfires happen, there is still a possibility to get an insurance coverage. You buy a policy, maybe it's going to be expensive, but maybe there's more pools to share. This kind of solutions, this kind of talk needs to be happening on our side. But on the root cause, the cause of the problem, I don't think that's the task of the reinsurers, insurers, or brokers. That's my opinion.
Yeah, and of course, I couldn't let you go, Sandro, without talking a little bit about alternative capital as well. It does continue to grow in influence. So, do you think the relationship between traditional reinsurers and capital markets is becoming more collaborative or more competitive?
Well, I think again, going back times, I think it's been much more um, collaborative, or let's put it that way, maybe less competitive. That's probably a fair middle ground. I recall back in the days when cat bonds came around, there was quite a bit of a pushback from the traditional reinsurance side in the sense of that's not really going to work. That's just a short blooming of ideas, and when things happen, big events happen, they're not going to be around to cover the claims and all that sort of talk. I think that has gone after 30 years of experience with ILS or at the alternative capital per se, because it has shown that it works. It does work. I mean, we have had some phases, say 17, the HIM phase, 17, 18, 19, when the industry went through a bit of a test phase, but that was more in the area of opportunistic behavior rather than the fundamental cause of does it work or not. Let's leave it at that side. We're calling it opportunistic. I think people will probably know the names that come up here. But yes, less competitive in the sense of we need each other, right? So traditional reinsurance, and alternative capital, they're working together in the sense of even substitutional to a degree. A cat bond is a substitute to a catastrophe excessive loss layer per se, with different properties, but it works as reinsurance. So why should there be much talk about whether it works or not? It does work, and the market has shown it does work. And more, we see the likes of supernaturals coming in here. We see the Red Cross being in that field. The fact that alternative capital works in the reconstruction and development field helped a lot for its acceptance. And we see less developed, that is in the sense of insurance development, countries to be part of the industry now. Think of the Philippines, which have had their foot in the door and already collected on reinsurance in that field. It's good. It's good to be in here together. And yeah, I like the space much more than it was 20, 30 years ago.
Another thing that has changed perhaps over the last 20 or 30 years is just the impact of these fast evolving risks, these emerging risks. So I'm talking about things like AI liability, energy transition, and of course, particularly right now as we're recording this, these geopolitical exposures. So how are reinsurers adapting their appetites for these new and fast evolving risks?
Yes, it may not be a big of surprise if I elaborate now on this part, but I think humans are generally event driven, right? So we experience something, and then we learn, and then we do something about it. So we're ready for the same thing again in 10 years, but we're still not ready for the things we haven't really anticipated. That's normal because we don't always want to think about the bad stuff, right? So, but the models adjust to reality, and the models become better and better. And so insurance will start to accept things like hurricane. After Hurricane Andrew, it took quite a while until more and more nat cat models were developed. And now the market is quite at ease with natural perils. Maybe not so yet about cyber, but cyber is just coming in. And we're learning about cyber. How does cyber work? We will have to learn more about wildfire risks. But I mean, geopolitical exposure, war type scenarios that we unfortunately have to learn again what it means. They're just coming back now on the screen of the C-level of insurance companies. And we have to probably, roll up the sleeves and learn. And are we prepared to take a hit? First movers tend to be those who make the most money. Again, the relation to cyber comes in mind. So back 10 years or so, and I'm not an expert in cyber, obviously, but back then, the first ones that came in don't really know what cyber is, but we're going to throw in some capacity, and the margins were big. Then you get the adopters to come in a bit later, and the margins get thinner and thinner. And until there are substantial and good accepted models in market, again, for cyber, we have now a couple of them, and the margins are thinner again, but there's more capacity. So I think this is what's going to happen with most lines of business. Some of you you just mentioned, Paul. And yeah, again, it's a cycle as humans are. So we experience, we get hit, we learn, we develop models, and then economically speaking, first movers, adapters, and then margins shrink, where people may retreat again, capital goes out, the cycle kicks in because prices go up, or the other way around, capital goes out, prices go up. Then we're back to the first question, right? Where we had of how does the cycle work? I think this is what's going to happen also in the risks that you just mentioned. AI particularly. I mean, what is AI? How do we learn? What's people like it, some hate it, but it's here to stay for sure. And insurance will adapt and offer products, I'm sure.
Yeah, absolutely. And Sandro, I think we all hope that you are here to stay as well, because there's been some great thoughts, and it's been very, very interesting to hear you and your debut appearance with us. And no doubt, of course, there will be plenty of developments in time for Q3. So stay tuned and join us again right here at Reinsurance Business TV.